Hey there, and welcome back to Crypto Clarified. This is a podcast series where we come together from time to time to discuss the most captivating headlines and trends from the crypto space. My name is Benjamin Dean, and I am director in WisdomTree's digital assets team. And today, we're getting the whole WisdomTree crew out. I'm joined by Ryan Louvar, who's our Chief Legal Officer and Head of Business and Legal Affairs. And I'm also joined by Jeremy Schwartz, Global Chief Investment Officer at WisdomTree. This is going to be a great discussion today. You're going to love it. But before I start, I have to do the social media shout-outs. If you're in the US, you're a US listener, go and check out wisdomtreeprime.com. Go search it in the App Store, Apple, Android, whatever you like. Go and have a look. You won't be disappointed. Hit subscribe, regardless of whichever platform you're on. Hit subscribe and share it with your friends, because as you know, sharing is caring. And as always, you can find me at Benjamin Dean on the Bird app. So for today's episode, we're going to discuss two very topical subjects that you're going to love. The first is around spot Bitcoin ETF applications in the United States. There's been a lot of movement in that space recently, and it's caught a lot of attention. So we're going to go through that, and we're going to get two very informed people to help you think through and clarify what's going on. Because you know we love clarifying on the show. That's why it's called Crypto Clarified. Then we're going to talk about what has been a very recent and very interesting development, and that is an outcome in Ripple's case with the Securities and Exchange Commission. It's one step along a very, very long journey. But as we keep going along in this space and it grows, it matures, it changes, we get decisions like this. And it can be difficult to think through. If you don't like reading 100-page court documents, that's all right, because you got Ryan here, and he's going to help you in that sense. But before we start the episode in earnest, I have to do my usual shout out to James and Sam in compliance. And don't hit the 30-second button, folks. You don't want to do that because it's the best part of the show. Before I begin, I need to state the following. To clarify, the views and opinions expressed in this podcast are those of WisdomTree and subject to change. Anything we present in this podcast is not intended to be relied upon as a forecast, research, nor as investment or tax advice. The information and opinions expressed in this podcast are not a recommendation, offer, or solicitation to buy or sell any securities, and reliance upon them is the sole discretion of listener. Please remember, past performance is no indication of future results. Great. That's done. Now we get on to the fun and interesting stuff. First of all, Ryan Louvar, welcome. Thank you very much for joining us today.
Thank you, Ben. Thanks for having me.
Jeremy, you've been on the show a couple of times now. It's great to see you. How are you?
It's great to have the real expert on the show with Ryan telling us what's happening in the legal world. Everybody's speculating. What do these applications mean? We have somebody deep in the weeds on these filings. It's great to be here with Ryan.
Yeah, it's absolutely fantastic. I appreciate you both taking the time, not just to chat with me, but also for the listeners' benefit, because these are complicated matters and they do move relatively quickly. So your views to help clarify these topics is very much appreciated. To kick things off, we're going to talk about spot Bitcoin filings for ETFs in the United States of America. And Ryan, just to help listeners think this through a little bit, could you give them kind of a snapshot of the past, really, because it's a relatively long history, and just help them kind of orient where we are and what's happened before us?
Yeah, so spot Bitcoin ETFs in the U.S. There's been filings well over 10 years now by different filers to try to get that approved by the SEC. Those have ultimately all been disapproved by the SEC. At different moments of time, these filings have sort of ebbed and flowed. You'd see, 8 years ago, a series of filings get disapproved, a couple years of waiting. Part of that was also in the disapproval orders, trying to address items that the SEC noted. For instance, a maturing Bitcoin market, different exchanges that are involved in the marketplace, maturing service providers in that space. So really, I'd say there's been a significant uptick also in the last probably 3 to 4 years in the filing. So if we go back a couple years, say 3, a number of renewed, some prior issuers refiling, some new issuers trying to get into the space with new filings. Part of that was potential enthusiasm around Gary Gensler becoming the chair. The thought is that he very knowledgeable in the space, professor at MIT, taught classes on cryptocurrency, and that the efforts before might see some momentum with him as chair. So ultimately, the rejections continued. That's not to say, though, that the SEC, hasn't warmed to Bitcoin a bit. About 2 years ago, the filers then filed actually to add Bitcoin futures to portfolios. So not actual spot Bitcoin, but Bitcoin futures. And that began in slow increments, essentially. So what the SEC first allowed was, and these are traditional ETFs registered under the main body of law governing ETFs and mutual funds. But they first allowed very micro exposures of Bitcoin futures and mutual funds. And ultimately, over a year-long period, that became to an approval essentially for ETFs to hold 100% Bitcoin futures. That then precipitated, some excitement that if Bitcoin futures have been approved, maybe now is the time for spot Bitcoin. So with that, you saw some renewed vigor in those filings. Part of that rationale was that, historically, one of the main reasons for the rejection of spot Bitcoin filings was a concern around the price of Bitcoin and its potential for manipulation. And the futures actually are priced the same way that many spot Bitcoin ETF filers are using basically the same price source. And so with that, the thought was maybe that concern of the SEC will go away. That essentially did not address all the SEC's concerns, and ultimately that sort of suite of filings were all rejected. Largely out of concerns that the SEC indicated there's still concern for manipulation in the spot Bitcoin market because they're not regulated like a CME futures is regulated. And with that, there's not a regulated market of sufficient size where the exchange has a surveillance sharing agreement. And so what's happened more recently is one of the filers filed indicating that it would enter into, or had ultimately entered into, a surveillance sharing agreement with one of the spot Bitcoin exchanges. And then on the heels of that, a number of other filings added that as well, to ultimately, try to, get the spot Bitcoin ETF approved. And so right now there's essentially a waiting game to determine, how the SEC, might react there.
Great. Thank you for that. That's a really great, succinct explanation of, as you say, well over a decade of activity in the space. For the listeners who don't fully understand the implications of a difference between spot and a futures-based product. So, Jeremy, well, I'm based in London. You know that there are Bitcoin exchange traded products that operate in Europe, and there is a difference between a futures product and a spot product from the investor's perspective, right? Could you just quickly run people through why or how they're different? And I'm thinking specifically about roll yields and contango, but you are the expert, so I'd leave it to you to kind of clarify it for the listeners.
It's really interesting. As Ryan said, the SEC had gone in increments of allowing micro to up to 100%. We were, one of the firms who thought about getting 3% in some of our commodity strategies, and we've thought about that because we thought Bitcoin futures acted like gold. Its use in client portfolios was as a competitor to gold. People say, hey, you can only mine a certain amount of gold, sort of like the digital mining of Bitcoin, and it had some use cases as a currency like gold. And so we thought about it in that commodity framework and have added to a few different strategies in that perspective. There was a lot of fears when the Bitcoin futures funds were first launched, the 100% funds, that because of the future, they have that slope of the futures curve, and when it's an upward sloping curve, so that a futures price is higher than current prices. By the way, when you have interest rates, it should be an upward sloping curve, because if you can keep your money in the bank earning 5% like you can today, what you're willing to pay for something in the future has to reflect that you could have put 5% in today. So the interest rate market implies an upward sloping curve, but the cost of rolling futures, right? When it's an upward sloping curve, you're not getting the current spot prices, and people worried because people put in expectations in addition to just sort of raw interest rate differential. There's storage costs that you have to factor into. If I'm going to buy it in the future, somebody's got to have it today. They got to store it over time. So there's sort of security costs of owning, so that you could sell it to somebody in the future. There's the interest cost of capital implied, but people thought you might get 10 to 15% cost to roll these futures. I think quite interestingly, some of the futures ETFs have done a pretty good job of tracking spots since they've been out there, which is just another way of saying the contango hasn't been there from where people really first thought when the futures curve was first coming out. So that's just one interesting observation. I think the most interesting element is what Ryan was talking about is, if the prices are similar, where is that real concern of manipulated prices from the SEC, Ryan? If you wanted to expand on that particular angle, is that the real rub of the issue? Is the surveillance sharing issues the real rub of the issue? People have said when gold was first launched, there wasn't surveillance sharing agreements between gold and when they first launched a gold product. Is there something that makes Bitcoin different? Is it, any speculations you would have on this Bitcoin futures price and this spot price?
Yeah, I think it's interesting because that is certainly an element that the FCC has been criticized for. That if the concern is around manipulation, then how can you approve the futures product and not a spot product? I think a couple reasons there probably are. The futures products have a sort of a natural gate on the amount of size that they can be through futures position limits. So you haven't seen those products grow beyond $1 billion. So when we say that the SEC has kind of moved incrementally in allowing products to be approved, there's an incremental to allow the futures, and they are also then somewhat gated by the limits there. Whereas in the spot market and a spot Bitcoin ETF, there won't be that gate. And so, I just, purely speculating here that might be another reason, is that a concern that the spot Bitcoin ETF may grow to be large, or multiple ones might grow to be large, which might not have the gates in there that the SEC at least has approved so far. I think the other probably difference too is that there is at least some data, some sharing of data and understanding of kind of how those futures trade. Whereas at this point, and this is the key crux to what the SEC is getting at, there isn't data from, or historically hasn't, from the spot Bitcoin exchanges. Now you might say, well, it's the price at the end of the day, but certainly the SEC has been very focused on regulating that spot Bitcoin market. So I think part of it plays into there, where the SEC has been focused on at least regulating these exchanges more broadly, I should say, than spot Bitcoin particularly. And if these exchanges aren't coming in the regulatory ambit of the SEC, if you will, then that's essentially a gating item for the SEC. Now with the entrance into these surveillance sharing agreements, I think the question is going to become what the SEC's asked for is a comprehensive surveillance sharing agreement from a regulated market of significant size. And so, I think the key terms: comprehensive, regulated market. And the question is, that regulated market doesn't have to be by the SEC. We have gold ETFs, we have plenty of other, oil ETFs where that core market isn't regulated by the SEC. But the SEC today has said, these exchanges just aren't regulated in a way that they believe is sufficient. So can somehow that be overcome through this surveillance sharing agreement and other information that the exchanges and issuers are providing? I think that's probably one of the key questions we're left with right now.
Okay. So you've pointed straight at kind of what has changed in the last few months to address the previous, or at least one of the previous concerns. That's these surveillance agreements. Ryan, I don't mind who answers it. Maybe you both have thoughts, but in terms of like nuts and bolts, just for the listeners' sake, when we say surveillance agreement, it's with whom? Regulated exchange, Ryan, as you just said, but like who is doing it, and how does that work, and how does it potentially alleviate the problem? Just for the listeners' sake.
Yeah, so really, so the exchange, so it's any of the spot Bitcoin exchanges. So Coinbase has been publicly named as being the exchange that's entered into these agreements, and basically with essentially Nasdaq and CBOE at this point, those are the exchanges that have made the filings for issuers. And so what that would require Coinbase to do is to share significant reams of data with the exchange, the SEC regulated exchange, Nasdaq or CBOE, that could then be further shared or examined by the SEC to really determine whether this activity that's on exchange is is manipulative conduct. Is there any evidence of any untoward activity? Just really trying to oversee that data and how it works. So I think kind of that's one nebulous thing. What is the SEC going to expect from that data? And will it be enough, if you will? And I don't think anybody today knows the exact answer to that question. Although the belief is that if there is a comprehensive surveillance sharing agreement, that regulated market may be of a significant size to be able to satisfy it. So that's the hope, certainly.
Okay, clear. It's as the listeners know, I spent
The one thing I'd add, maybe just stepping back, is just understanding kind of what's different here. Why is it taking so long for these Bitcoin ETFs to be approved when other types of ETFs go to market, in 75 days? And really the difference here is in the filing that we're talking about is one that the exchange makes. So, the vast majority of ETFs in the U.S. today are governed by what's called the Investment Company Act of 1940, which governs funds that invest generally in securities. So, our typical stocks and bonds and the like, which at some point will be a segue to the Ripple discussion. But and really, even going back a couple years, there weren't listing standards for all types of ETFs to be listed on the exchange. And so what ETFs had to do is essentially apply through the exchange for special listing rules. And that goes through a process, not to get too technical, called Rule 19b-4 under the Securities Exchange Act of 1934 that governs essentially exchanges and secondary market trading activity. But what that does is it's essentially an application by the exchange on behalf of the issuer to make up essentially listing rules that'll satisfy the commission, SEC, that these rules are designed to prevent fraudulent and deceptive conduct. The reason that it can take a long time is because that type of filing is completely subject to the SEC's discretion in terms of how they're reviewing it. there now are specific timelines. So you see generally that these are reviewed, within 6 months, and then the SEC will either extend it or reject it, and then ultimately leading to an approval or rejection. But it's those really filings that are key to what's been necessary, and it's not like existing ETFs, part of an existing complex that invest in securities. Those ETFs just don't have to go through this process because they meet generic exchange listing standards and can generally go automatically effective in 75 days. So here, it's not a new process per se. Many ETFs have had to go through it, from gold to oil to ETFs investing in commodity futures and the like. But here, the SEC can really dictate what their expectations are. And so that creates a little bit of a nebulous atmosphere to really understand in time what the SEC truly wants.
I see.
And let
Okay.
me jump in with one more
Please.
question here for Ryan, because Ryan, there's a lot of the ETF analysts on Twitter in particular speculate about what each little step of this process means. People are studying these 19B4 filings. There's probably like 30 applications in front of the SEC. In terms of the key timelines, milestones, there's news like, hey, the SEC put something in the Federal Register. What do all these different things mean? Do you have this is pure speculation, but do you think they will allow one person to list before everybody else? Do you think there'll be a group of these things that come together? How do you think through these steps in the process?
Yeah, that's a good question. I mean, essentially, the way the process works is, the exchange is responsible for the filing, so it works closely with the ETF issuer or sponsor to help develop, information and facts around the ETF. But then, for instance, the surveillance sharing agreement is entered into with the exchange itself. So it's kind of the key new piece of information. Once that whole document is drafted, the exchange then essentially files that with the SEC, and the SEC looks at it and can reject it for technical reasons generally. So here, these were initially rejected because the exchanges indicated that they would be entering into a surveillance sharing agreement. And so I think the SEC's reaction was, that's really not new. You're telling us you would. That's a requirement anyway. Show us the agreement. Tell us you've entered into an agreement. And so you saw then a flurry of refilings to do that. Once the SEC accepts those, that then gets published ultimately in the Federal Register, which that's kind of the key item. And that's what a lot of the reporting that you were just mentioning, Jer, is now that kicks off a timeline to then where the SEC, needs to respond by. And so, generally that timeline extends well into the 9-month time frame. But that's why you'll start seeing, and then you see also that a certain filer filed first, somebody filed second. Generally speaking, I'd say we've historically seen ETFs launch in sequence of those filings. Here, I'd say it's a little bit different because we have a second piece that frequently isn't focused on, and that's actually the prospectus. So right now, you have all the issuers that have filed prospectuses, but if you look at the prospectuses, they're largely sitting there. Normally, what you'd see is a sequence of prospectus filings and updates. 1 month, next month, another update. And what's that showing is there's a dialogue with the SEC on the prospectus, and the issuer responding to comments to hopefully get the SEC to allow that prospectus to be effective. So even if these exchange filings are approved, then you've got to move to the prospectus process. And that's going to depend on, what's the extent of the comments. That's where there are some nuances, in the different ETF filings. Different filers have different custodians. That might be important to the SEC. They're using different price sources. So those filings are going to have different questions come out of them by the SEC. and either how quickly the issuer can respond, or if the SEC then focuses on some piece of those filings where one issuer has addressed most of the questions more promptly or in a more satisfactory way to the SEC, that issuer, even though they may not have been first technically to get that exchange listing approved, might ultimately be the first to get their prospectus approved and launch. So to me, it's those two items that need to come together for approval. But if you look at all this timeline, where we still could very well be, a good, year and a half away, even under the best circumstances, I hate to say.
Hey, that's a great explanation there, because it leads to what I wanted to ask next, which is like, from where you sit, you've mentioned the surveillance agreements to deal with potential for market manipulation. You've mentioned a few other elements there, like the custodian, the pricing source, and whatnot. Are there any kind of sticking points that you think that folks should keep an eye on, at least those who are on the Bird app, but also those who are kind of interested in the process? Where else might there be obstacles or roadblocks that means that it's not 3 months, it's maybe 18 months? Where might they lie specifically for this kind of a product?
Yeah, I mean, I think it's going to be when we start some months down the road, start seeing the response to these 19 before listing applications. If those are ultimately approved, which is certainly an if. I think that what we may see from those is that the SEC asks for more information. Those are frequently amended during part of the process, so we might see more detail around the surveillance sharing agreement and the type of detail that's being described there. Although it all is already pretty detailed right now, much of the information provided. Might see some more there. But I think it's really then once those are getting to a place, then the question becomes, does the SEC, they've approved the listing generally, but do they have questions from a prospectus standpoint?
Okay.
And I think once we start then seeing sort of those prospectus filings start updating, that will help give an understanding of the types of issues that the SEC might be thinking about, in that regard as well. Certainly one of the reasons they've approved the Bitcoin futures ETF is because it's the futures are custodied through SEC or CME regulated entities, and can be custodied by brokers, SEC regulated. That's not the case with spot Bitcoin. So I think there will be a focus on the custodial aspect, and certainly, how is that Bitcoin being overseen in a way where the SEC can be comforted that there are sufficient controls in place to be protective and oversee the actual spot Bitcoin. So probably that cadence is the next item to keep an eye on once the 19 befores hopefully move through the process.
Okay, got it.
And let's go back to Ripple. This security, Ryan talked about, he teased out that one of the concerns is things that are called securities. There's this whole question, are crypto assets securities? And there's been, the sort of famous lawsuit with Ripple, and there's some commentary from the judge. What's your first impression of all the interpretations, which is, some of the exchanges saying, hey, we are no longer in Gensler's crosshairs because we are not dealing with securities. Is that a step too far from some of these exchanges to be making those comments?
But Jeb, before we do that, guys, like, for those who don't follow court cases too closely in the United States around crypto asset securities, just before, Ryan, just for 30 seconds, can you just explain what this is? Because it's been a 3-year journey and it's not obvious to everyone, but that's important context for us to see the decision here. And
exactly. And I think in the explanation, I'll take us back to the 1940s, actually.
All right, let's go.
Which would be fun. But no, so look, the SEC has been very focused on indicating that, I think the statements are that a significant or majority of cryptocurrencies are securities. That the SEC has then taken essentially filed enforcement actions or litigation against certain issuers. The issuers of XRP, Ripple is one of those cryptos that has been sued by the SEC. So that suit started a couple of days before Christmas, I think, three years ago, as you mentioned, Ben. And really, the heart of the issue is that if we think about sort of what is the definition of a security, if you look in the statute, you'll see things that we always think about: stocks, bonds. But then, a few lines down is this term investment contract. And so essentially the SEC has taken the position in their enforcement actions or these, cases that they're litigating that certain digital assets are investment contracts. And so that takes us then to the 1940s, where there's this Supreme Court case called the SEC versus Howey, Howey. And basically what that determined is the question there was whether an offering of units in a citrus, an orange grove development that was coupled with a contract for sort of cultivating the oranges, marketing the oranges, and then remitting proceeds to those investors was an investment contract, and a la a security. And if we step back and say, if I'm selling you, Ben, an orange grove, nobody would call that a security. I mean, I'm just selling you an orange grove, or I'm selling you an orange.
That'd be nice.
But if I'm doing other things to potentially enhance the value of that orange through this enterprise, where then your expectation of profits is from what I'm doing, that is then an investment contract. And how in that case, the Supreme Court indicated that in fact was an investment contract. And really it comes down to, sometimes it's articulated as 4 factors, but I'll articulate it as 3, as the court did in the Ripple case. And it's really an investment of money in a common enterprise with the third prong and an expectation of profit solely from the efforts of a promoter or a third party. And so that's been the question, are these investment contracts? And the SEC has over time, I think, really through either enforcement actions or even pronouncements and statements, kind of broadened many interpretations of what each of those elements and how those elements might be met. So right now we have a fairly broad landscape, as largely determined by the SEC, not by the courts, around what would meet this definition, that is now seeing some challenge in the courts. And honestly, the litigated cases to date, the SEC has largely been on the winning side. And so this was the first time really where there was a decision that said, wait a second, we actually don't have a security here, not an investment contract. So maybe I'll stop there, and then we can maybe dig into the weeds a little more on how on exactly kind of what that meant.
Yeah, let's do that, because it is quite nuanced, this one.
Yeah, it is very nuanced. So I think the headline item, which I think the crypto industry really cheered for, was that the judge said, XRP inherently is not a security. It's basically just a digital token. So, that's not a security. And so, when the SEC is saying crypto assets are securities, and you have a judge saying inherently this crypto asset is not a security, that, seems to be a win. Certainly. Then the judge said, if you're talking about an investment contract, that's very facts and circumstances specific. So you really need to look at the facts and circumstances. And there were a couple of different instances that she looked at. The first one was sales to institutions, where the Ripple executives sold XRP to very sophisticated institutions, hedge funds and the like. Made statements around XRP, and basically the judge said, in that instance, we have these sophisticated purchasers that were purchasing directly from Ripple. They must have had an expectation of profits. They were sophisticated. They truly understood what the Ripple executives were talking about, the whole nuanced business of Ripple. And in that case, all those factors coming together really created this investment contract. So an investment money in a common enterprise, Ripple, with an expectation of profits to come from essentially Ripple's actions, Ripple making the enterprise better. So there's an investment contract. But so that was definitely, win for the SEC for sure. But then you go to the next piece, and the judge said these what she called programmatic sales. So essentially sales on exchanges that the purchasers on exchanges didn't know they were buying from Ripple, and they may very well not have been buying from Ripple. We don't know what their motives were for buying. Many are buying just to be speculative. They're not expecting profits from Ripple's efforts. Probably many are unsophisticated, so they're not parsing through all these statements that Ripple's making out there to try to weave together an understanding of what Ripple's doing. They're just trying to invest in a crypto and, hey, make some money if it goes up, And so the judge said, there's no investment contract there. That doesn't have this, especially this third prong, an expectation of profits from others. They're just buying on an exchange. And so that was really, I think, and then when you're saying the exchanges are now saying we're listing Ripple, that's what they're really hanging their hat on is this statement. Now, there's a little bit of ambiguity in the decision because the judge said that, but then there's a footnote that says, but I'm not addressing more broadly whether any crypto sale on an exchange is not an investment contract. But you got to draw the line between draw a line from what the judge's reasoning was to any other crypto being sold on an exchange. You got to look at the facts and circumstances, but the exchanges clearly are becoming comfortable enough that their prior analysis, the assets they were listing weren't securities, still holds, and is even further emboldened now through this decision. And then the third piece was that Ripple was distributing XRP to other third parties, like employees, and those were also determined by the judge not to be securities, or more particularly, not to be investment contracts. So we still have a little bit of clarity that needs to be provided. I think I think a lot of people that are looking at the decision sort of step back and say, well, gosh, this from a policy standpoint just doesn't make sense. The sophisticated sort of purchasers are being protected by the securities laws, but the exchange purchasers, aren't being protected by the securities laws. But I think you need to step back from separate policy from legal. And if the answer is that these types of transactions aren't securities, then they're not securities. And so from a policy standpoint, that's likely where Congress needs to step in if there's viewed as being a gap there to really fill that gap, which has been a lot of the dialogue in the industry around there needs to be legislation here to more carefully define what crypto is and who should be regulating it. So I think that dialogue is only going to increase in the coming months.
I mean, what's interesting is on the back of that news, you saw a lot of these what you call altcoins that are not Bitcoin Ether. Bitcoin Ether have been in their own world. You got the futures that trade off Bitcoin and Ether, but everything besides Bitcoin Ether has been lumped into this altcoins type universe. And they definitely. It's funny because we talk about the security of the SEC being under their regulations, but the people actually rejoiced when they said these things were not going under SEC regulation, that there'd be more maybe trading interest and speculation activities going on them. There's certainly some positive price moves on there. I mean, people talk about the ETF as being another positive catalyst for Bitcoin itself, that, if the SEC is worried about pricing and manipulation. There's nothing like the transparency of an ETF wrapper to trade it institutionally, bring down some of the cost to access some of these things. So there's some benefits of the ETF structure that can happen from that. But in terms of the from the SEC's view, it is a clunky trying to map, what you typically think of securities laws and what you have to do to comply as a public company versus a public token. Are they going to have to, if they do go down this path of calling more of these things securities, how do you see the digital tokens? They're going to have to come up with new laws, it seems like.
Yeah, I mean, the implication from the ruling is that you essentially have a dividing line, that at some point something, XRP in this case, was a security. There was an investment contract in the sales to the institutions, where, and to your point, Jer, what that means then is that the issuer needs to draft a prospectus, needs to have that reviewed by the SEC, needs to file a bunch of other documents, needs to wait for the SEC review that, address comments, give that to investors, or rely on an exemption, which in and of itself typically has disclosure requirements. But then at some point in certain transactions, that same token, because the token isn't a security, but there's this lack of this elements of an investment contract, that thing that I'm buying isn't a security. And so where is that dividing line? And so if I'm buying on an exchange, it seems like, at least if you extrapolate, now the judge said you can't extrapolate, but many are extrapolating that many other digital assets are going to be the same. They're not securities. It's tough. I think that you're in an area where we really need, if you want clarity, some congressional action to really do that. And I think part of that too is that the SEC has really been largely very aggressive on the enforcement front, and so a lot of industry players are saying, look, if that's how the regulation is going to come to be and the interpretations, then the SEC really isn't the regulator of choice, even though we want to be operating in a regulated environment. Crypto industry says the SEC, with their posture, isn't the regulator. It should really be the CFTC or some new one. We'll see, if Congress moves. There's a couple bills out there, and certainly following the Ripple decision in the last week, there's been a number of congressional representatives that have really been speaking out, saying we need to legislate here, because really the judge's decision does leave, from a public policy standpoint, something that isn't satisfying. That sophisticated investors are protected and exchange buyers aren't. But that doesn't mean that the securities laws need to cover them. It means that there probably should be some law covering them. And the question is, what is that going to be? Going from there.
Got it.
Time will tell.
Yeah, time will tell. We're coming up on time, so this is usually the part of the episode where we pivot and ask about where you think the future is going. Ryan, you've already kind of pointed at one area there, just watch Congress. But just thinking about one or both of these topics, spot Bitcoin ETFs, and Jer, I'd be looking for you there. Sometimes I'm asked about, like, how would we expect markets to respond if an approval came through? Of course, you're welcome to talk about Ripple as well, because we already saw what happened with the court case and the price. And then, Ryan, like, where do you think, and you've touched on it there, because it's, is this generalizable? Can it be appealed? Things like that. Where do you think things are going, or what should people be keeping an eye on over the next 6 to 12 months? And Jeremy, I'd ask you to kick off, and Ryan will close out with you.
I think what's really interesting and what's driving the price, 2022, you had a bear market in tech, driven by higher interest rates. You'd say things that don't carry a profit stream, like there's no interest that comes off Bitcoin. It's the cost of capital went up, and so that you could say is some underlying pressure for some of it. But what you had this year, again, a banking panic, people sort of losing some faith in the deposits of banks. And then that also brought more interest, and it sort of some of the hallmarks of when Bitcoin was first created was concerns about the banking system and having this alternative in terms of having a sound money type policy, a fixed number of Bitcoin ultimately in existence. Sort of very interesting questions. I wonder, will the ETF really bring in a new class of investors? I mean, if people want Bitcoin, they obviously have many different ways of getting access to it. They could hold the physical, they go on the exchanges. What it removes a stigma. I mean, there's still a stigma from some people of it's not in their traditional wrappers. You got to open these new accounts. And I do think the cost of trading will come down. So whenever you democratize something from an ETF structure, it does help bring a new class of investors. So I do think there will be some incremental demand from, hey, I could buy it in my Schwab brokerage account instead of opening a Coinbase account. I think there is some element to that. But I think it's the stigma more than anything, because I think there's the sort of lack of clarity from the regulators has made questions, and I think you might have seen more RIAs, advisors put it in more if they understood how they would be regulated. And so I think that's the big question, even beyond Bitcoin, is how does this all fit in from a regulatory standpoint? And so I think this Ripple one is as much interesting as the Bitcoin ETF. That to me, the broader application is beyond Bitcoin.
Yep, absolutely.
Yeah, I'd agree. I'd echo what you just said, Jared. I think, just following up on Ripple. I mean, I think the interesting thing to watch there is going to be, will the SEC appeal the decision? They certainly won one prong, but I'd say that the prongs that they lost are probably, more important, maybe. Certainly from a policy standpoint. The crux of it, though, is that right now it's a one decision from a district court judge. Although important in the Southern District of New York, very persuasive to other courts. If you appeal and lose, you then have the entire district courts within that jurisdiction then covering, and then you have further solidified through an appealed decision. So I think that'll be interesting to watch. And also I think how the exchanges and issuers respond. It's interesting because to the facts of the case in terms of the exchanges, how they might change their analysis as to what is a security, which I think many of the exchanges in the U.S. Certainly have. Very prescriptive processes around that, and then also how the issuers respond to. I think will be interesting. Still clarity is lacking. So it'll be good to see if we get any clarity, also including from Congress.
Yeah.
That'll be fun to watch.
I hear you. Great. Well, look, listeners, I tell you, these topics, there's so much nuance, and the whole reason we do the show is to bring clarity to these kind of topics, help you think it through and understand what's going on. There, you've just gotten a masterclass in it. So, Ryan, Jeremy, I thank you so much for taking the time to explain all of this today. Unfortunately, though, and as much as I'd love to keep discussing this, we are out of time. I hope everyone's found today's podcast useful and informative. If you're in the US, go to WisdomTreePrime.com. You can also find it on the Apple and Android app stores. You can find me at Benjamin Dean on the Bird app. Thank you very much, Jeremy and Ryan, for participating today. And thank you for listening as well. I can't wait till we see each other next time.
Thanks, Ben.
Thank you.